All right, that's good perspective. Let's get into pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first pro pick is Carvana, and I have been just dying to bring this up with you because this has been kind of an insane stock, the most insane stock. It's 20% of your fund, which I also think is insane, and you're going to tell me why it's not. Let's backstory Carvana, the used car retailer. Let's start at the pandemic. What happened in the pandemic? Let's talk about what happened after.
Yes. So Carvana is an incredibly unique business run by a very uniquely talented team. The real backstory is Ernie and several of his founders. Ernie's the CEO of the company. His dad owned a large car dealership. And so he grew up in the business. He knows the car dealership business exceptionally well. And if anyone who's bought a used car would know that the process really hasn't changed for decades, and it generally doesn't make anyone feel good. You usually are at the dealer for a full day and you leave thinking, did I just get ripped off? Like, I feel like I just got sold something and got ripped off. And so Ernie had this view that we could change that by allowing it to be a complete self-serve process where you get all the information online, you know all the imperfections about the vehicle online, you can fill out all the paperwork online, you can do everything online, and then it gets delivered to your house. If you like the car, you keep it. If you don't like it, you give it back. And so they started the business in 2013. Immediately realized, wow, consumers love this. This is a great model. But to build out this business, they have to have reconditioning centers. So when they buy cars, they got to clean them up, get some dents, make sure they're working, so they're not going to sell a broken car. And they can't do that in Florida and then sell a car in Seattle. So they had to go on this insane growth tear, frankly, from 2013 to 2021. They went public in 2017 of just expanding across the United States. And when they went public, they had like negative 20% EBITDA margins. And by 2021, at the height of the pandemic, they were EBITDA break even. And so it was clear that there was really attractive operating leverage in the business. They had grown to become the second largest used car dealership in the United States, not just online dealership, all like second largest used dealership in the US. And their oldest market, Atlanta, had mid-single digit EBITDA margins, which is in line with industry norm, still growing 20%.
So we have all this amazing stuff. And remember, during the pandemic, used cars were they were more expensive than fresh cars because of the supply chain disruptions. Yes. You literally couldn't get one. So that must have helped the story as well.
So that was a narrative at that time. It helped them for about a quarter, but then it didn't, because the thing that people missed at that time was to sell a car, you got to buy a car. So if all of a sudden car prices go up significantly, then everyone's trade-in value assumption is going to be higher as well. So the people who benefited more from that were franchise dealers. Used independent dealers like a Carvana benefited for like 3 months, and then they didn't. And in fact, they actually probably could have grown faster if the pandemic didn't happen, because it was so hard to staff their organization with the social distancing and whatnot.
So the market had a different opinion of that.
It did.
Because the stock peaked in 2021 and then proceeded to fall basically 100% over the next year and a half. Wait, I'm not finished. And then call it beginning of 2023 to where it is right now, it went up by 4,600%. Yeah. Okay, so it fell almost, and like when it fell, the obits were being written, bankruptcy filings, everybody moved to sell, and everybody just said Carvana is dead. It might not be able to continue.
Me and a few people did not say that.
And I want to know about that. And I think when you talk about the CEO, this wasn't just a CEO, this was a founder.
Yes.
And, a family sort of tie in there.
Yep.
I feel like this is where that situation matters, right? Because it wasn't just a CEO who's like, okay, well, this didn't work out, and I'm going to go be a CEO of another company.
Yes. So I asked Ernie, how did he, during this 2022 period, if you look at most growth-oriented companies, the ones that 2022 killed them, obviously all the management team left and changed. Even the ones that that had a turnaround, most of them had significant turnover in their executive ranks. Carvana did not have any. All the core people that ran Carvana, from when it went public, when it was a $10 stock to $300, all the way to when it hit $350, and then now it's at over $200. All of those same people are still there, and it's because they really believe in the model. They know the model works. The online used car retail model is a better model that still only has 1% market penetration, and it's a better customer experience. It's more profitable, and they have so much runway. They all believed, and frankly, they all bought stock. So like Ernie, all the other executives were buying stock at $20 and below. And then if we've seen the results over the last 2 months, what's happened is that people went from thinking this business doesn't make a lot of money, the economics don't work, which I knew wasn't the case because pre the collapse, we knew Atlanta was already very profitable. And then now it is the fastest growing, most profitable used car retailer in the United States.
There was a short report. Hindenburg came out with a short report alleging all kinds of financial chicanery. What did you think of it?
All of the points they made are points that other short sellers have made many times since they went public. All of them, shouldn't say all of them. None of them are points that I think are a concern to the long-term investment thesis. And I think most of it is just trying to spin a negative narrative about the business. Like the management team is very aligned. They are exceptional. Everything they've done has been to the benefit of shareholders, and they have an incredible business.
So what I want to know is, when did you get in?
When we launched the fund on March 1st of 2022, it was the smallest weight in the fund. It was a 2% weight in the fund, and our first buy was $128. Then the market obviously got very scared in the May, June timeframe of that year. Stock goes down to $40. We buy more. Then it goes to $20. We buy more. Then all of a sudden people think they're going bankrupt, and there's articles being published that I factually knew were not correct. Like things they were saying, oh, this business is going to run out of cash in the next 3 months. It was not possible for that to happen. And so our lowest buy was $7, and our average cost had to be around $30, and now it's a $200 stock, and I think it's going to go to $1,000 over the next 5 years. It is like an Amazon. The only difference between Carvana and Amazon is that when Amazon was at a similar level of market maturation, their margins were much lower than the industry norm. Carvana now is 1% penetrated, but they have double industry margins and are growing 50% top line right now in an industry that's flat.
And so fascinating to hear you say that this could be $1,000 stock, especially because there's been so much volatility because of the pandemic, post-pandemic. Mm-hmm. Let's bring that narrative to your second pick, which is HelloFresh. Everybody was doing HelloFresh during the pandemic. And then we could go to restaurants and we could do other things. Things started to open up. So HelloFresh went from being, like a $90 €90 stock, I should say, because it trades in Germany. And now it's below 11.
Yeah. So HelloFresh has a similar, you're going to see some rhyming going on here. HelloFresh has a lot of similarities with what happened with Carvana to some degree. They are run by an exceptional founder who's done an exceptional job building the business. But as you probably know from your own personal experience, a lot of people used meal kits in the pandemic, and meal kits is a high churn service. So if 100 people buy it in the first year, a year from now, it might only be 20% that are actually still using it, still making profit for the business, but that churn impact has an impact. And so during the pandemic, they went to the moon. Then they had to lap that, which caused pressure in the meal kit business. But at the same time, they bought another business called Factor 75, which you may be aware of because they've been marketing a lot in Canada recently, is a ready-to-eat meals. So it's fresh meals that you can throw in the microwave or throw in the oven. And they have become like the market leader in that space. And that business has been growing a lot. And so over the last couple of years, the business has gone from growing like a weed to pretty much flatlining. And the margins have gotten incrementally more negative because the growth has been driven by a younger business, a Factor, while meal kits is finding out the floor. And they were holding on to, we think meal kits can still be a growth business. And so that's what people were very skeptical of. And that's why if you look at the stock chart, it was like in the $20 to $30 range for a while. And then at the beginning of 2024, they finally came to terms with that the meal kit business is a mature business and they need to operate it as such, which means that there is a lot of profit to unlock of this business. If we're not trying to grow this 5% anymore and we're accepting this is mature, we can improve the profitability of this dramatically. And so over the last year, it's been like this huge efficiency kick. And at the same time, the ready to eat business is still doing really well. But everyone like lost faith in them pretty much when they said this. When they said, all right, guys, like meal kits, we're accepting it's not going to grow. It was like haha, we told you. And anyone who was believing them said, we're out. And then everyone who was a short seller who was like, we told you, is like, haha, we were right. We were vindicated. And so the stock has really been like it's really been dead for like a year while they're in this mode of, we got to prove this thing could be highly, highly profitable. Over that period, they've bought back 6% of the company through a share buyback program. The CEO took out a 10 million euro loan to buy more shares. He owned 4% of the company before. Now he owns 5%. And every quarter since that like disastrous moment, they've showed increasingly better profitability numbers. And I think that's going to continue. And I'm very excited about that.
There's Canada's Good Food as well. Is it a similar story or you prefer HelloFresh?
I prefer HelloFresh in the sense that HelloFresh benefits from being so large. So if you look at HelloFresh's competitors in every country, there's usually a local player like a Good Food. And those businesses are fine businesses. And I think Good Food is run by some really smart people. And I think they have a lot of opportunity in the future to grow as well. But HelloFresh is like the de facto dominant, like 800-pound gorilla of the industry that has a unique moment currently to dramatically improve profitability, which no one is giving them any credit for. And so I like my forecast over the next 5 years is that they grow revenue 5% a year. So I'm not saying this is going to be some sort of like crazy grower. It's 5% a year, but at the strong incremental margins that they've proven in their oldest markets before, which is going to make EBITDA go from a 5% EBITDA margin to a 10% EBITDA margin. So
it's like a profit inflection story.
Huge profit inflection. That's the thesis, is the profit inflection.
Okay, so continuing the theme in their pro picks, which is pandemic roadkill.
Yes,
picking up pandemic roadkill.
ThredUp
is your third pick. This one down massive from where it was in the pandemic. Used clothes?
Yes. So ThredUp is a really, really unique business. So when it went public in 2021, I was like, this is an interesting company. There's a lot of different used clothing marketplace apps. Like there's a lot of people on Instagram, on Facebook selling used clothes, running these little shops, or on Poshmark, Depop. There's a bunch of these different platforms. All of them are the same in the sense that they aggregate users and charge a commission. So they're not actually helping you operationally in any way. This is an app that people come together and transact on. ThredUp took a different approach. They thought, okay, people who take stuff to Value Village or Goodwill, they're doing that because they want it out of their house. They're not trying to like make an extra $7 by loading a picture online and selling it. They want convenience. And if someone could give them some money for it and it'd be incredibly convenient, they would probably do that. And so what ThredUp did is they had these ThredUp clean out kits, which are effectively bags. People could have the bag sent to their house. They fill the bag up with clothes that they don't want, that they want some value for. They send it to ThredUp's warehouse. ThredUp has a warehouse. The ThredUp opens the bag, looks at the stuff that they can sell. Stuff they can sell, they throw on a mannequin, they have to do all the processing, then they throw it on a conveyor belt, and it sits in their warehouse of millions of unique items that then people online are shopping for. And so that, like, the unique thing about ThredUp is that they're tapping into supply that isn't going to be sold.
And then what's their margins? Like, what do they get?
So that's why the business is so interesting, because that, like, what I'm describing is like, how do you make money sending them a $40 used sweater? Like, you got to pay freight to the warehouse. You got to have someone take it out, put it on somewhere. You got to store it, and then you got to send it to someone's house. And so historically, the business was not making money. In 2021, they were just focused on growing as fast as possible. They weren't making money. And then 2022 happened, where all of a sudden every shareholder just jumped ship and they realized, okay, well, we need to get to making money and prove that this economic model works. And so they had been on this like efficiency kick for 2 years. and went from not making money to being just about adjusted EBITDA break even. And to do that, they really would have had to show like very attractive incremental margins, which really proves out that this business can make a lot of money at scale. And so that process is now like, it's at an inflection now where they just started inflecting revenue at really attractive incremental margins, and they're now at a point where they're going to start generating like meaningful amounts of cash. And it's people are going to look at it. I'm saying this now. I bet you majority of people have not heard of the company.
I mean, I don't know if I'm going to buy the stock, but I'm going to go to ThredUp because I've been answering the same question about the same dress I've had on Facebook Marketplace for like a year, and it's just not moving.
Yeah, well, you're not going to be able to sell it because they don't operate in Canada right now. But
they don't. Okay.
Yeah, they're only US based, and they are solely right now focused on scaling what they have and showing that they have a really economic business. And based on the current share price, that is not the belief at all. If I told someone to look at the historical financials of this company, they're going to pull them up and say, this looks awful. But it is at a very, very critical inflection where incremental growth is going to come at very attractive economics. And it's going to bring this company on people's radar, because all of a sudden they're going to say, oh, this is a small internet company that has like true differentiation, because to build out what they've done, you have to open these massive fulfillment centers and figure out how to operationally make this work, which is really, really hard. And so that's why I like it so much.
This has been so fun. Thank you so much, Jordan, for joining me.